Hello guys, welcome to the Daily Dose by Finity. When we talk about investment in the stock market, the majority of investors relate it to the equity alone. But there are many options for the investor like equity mutual funds. Let's look at the top factors to consider before investing in stocks versus equity mutual funds. Diversification. Investment in equity mutual funds can provide the investor with instant diversification of portfolio in contrast to diversification in stocks, which can be achieved by investing in different stocks individually. Risk. Stocks and equity mutual funds both are subject to risk due to high market volatility. However, equity mutual funds can be considered less risky as compared to stocks due to their inherent feature of diversification. Taxation. Taxation cannot be avoided in either stocks or equity mutual funds. Equity mutual funds, however, provide the benefit of a tax-saving instrument of up to 1.5 lakh in the form of equity-linked savings schemes (ELSS). Stocks do not have such tax-saving options. Cost of investment. Investment in equity stocks involves higher costs, while investing in equity mutual funds comes at a relatively lower cost. SIPs are a great option here. Control of investment. Investment in stocks provide the investors with complete control of their portfolio. This control is not available to the investors while investing in equity mutual funds. Expert analysis. The biggest advantage of investing in equity mutual funds is the expertise provided by the fund managers to maximize your returns on the portfolio. Period of investment. Equity mutual funds usually need at least 5 years to 7 years to grow and provide good returns to the investors. Stock, on the other hand, can be traded immediately. Hope these points help. For more tips like these, follow our YouTube channel and Instagram page. Happy investing!